Welcome back to Ledger.Wealth.Network, XRP Daily News, where we break down what's really happening in crypto before the headlines catch up. If you want the signals, not the noise, you're in the right place. The banking industry just got flipped upside down, and XRP holders are sitting at the epicenter of the biggest financial transformation in decades. While everyone's focused on price charts, the real story is unfolding in boardrooms and congressional halls where the future of money is being rewritten. Here's what the mainstream media isn't telling you. We're witnessing the birth of a parallel banking system where crypto companies aren't just challenging traditional banks, they're becoming them. The old guard thought they could keep crypto in the shadows, but now SEC Chair Paul Atkins and Treasury Secretary Bessent are lighting the path forward with statements that would have been unthinkable just 2 years ago. Most people think crypto adoption means more retail investors buying coins on exchanges. That's thinking small. The real disruption happens when Coinbase can offer you the same services as Chase, when Ripple operates like Wells Fargo, and when your stablecoin yields beat anything a traditional savings account could dream of offering. I'm going to show you exactly how this banking revolution is unfolding, why the economic headwinds we're facing might actually accelerate crypto adoption, and the specific price levels where smart money is positioning for XRP's next major move. Let's start with the economic reality that's forcing everyone's hand. The Federal Reserve is trapped in what economists call an impossible trilemma. GDP growth just collapsed from 4.4% to 0.5% in Q4. That's not a gentle slowdown, that's an economic cliff dive. Simultaneously, inflation pressures are mounting as oil prices surge past $100 per barrel due to Middle East tensions that show zero signs of resolving. This creates a nightmare scenario for traditional monetary policy. Raise rates to fight inflation, you'll crater an already weakening economy into recession. Lower rates to stimulate growth, you'll pour gasoline on the inflation fire. There's no clean exit from this trap using conventional tools. But here's where it gets interesting for crypto holders. When traditional systems fail, alternatives flourish. Treasury Secretary Bessent just declared that crypto is a technology the world is adopting. Not might adopt, is adopting. That's not crypto cheerleading. That's economic pragmatism from someone who understands we need new solutions for new problems. The stablecoin market represents the clearest example of this shift. 99% of stablecoin value is denominated in US dollars, creating unprecedented global demand for American outside traditional banking channels. For a country drowning in debt, this isn't just convenient, it's essential for maintaining dollar dominance in an increasingly multipolar world. Now here's the bombshell that changes everything. The final agreement between major banks and crypto exchanges that makes stablecoin yield not just possible, but inevitable. This isn't about crypto companies asking permission anymore. This is about integration at the highest levels of the financial system. SEC Chair Paul Atkins isn't mincing words. He's calling on Congress to future-proof against rogue regulators and advance comprehensive market structure legislation. Translation: the regulatory uncertainty that's held crypto back for years is about to end with legislation that treats digital assets as legitimate financial instruments, not exotic gambles. But the real game changer is the banking license rush. Coinbase, Ripple, and other major crypto platforms are all applying for specialized banking licenses that let them offer yield on stablecoins without the full regulatory burden of traditional banks. Think about what this means. Your crypto exchange becomes your bank, your stablecoin becomes your high-yield savings account, and your DeFi protocols become your investment platform. This isn't some distant future possibility. Companies are filing these applications now because they see the regulatory green light coming. When you can earn 8 to 12% on stablecoins through regulated insured platforms, while traditional banks offer 0.01% on savings accounts, where do you think money will flow? The Middle East situation adds another crucial element to this equation. Iran's president just issued a stark warning about ceasefire violations, stating their hands will remain on the trigger if aggression continues. This isn't empty rhetoric. It's a direct threat to global oil supplies through the Strait of Hormuz. Oil markets are already pricing in this risk. We've seen crude prices climb $1 per hour during recent trading sessions, and that inflationary pressure is exactly what makes traditional monetary policy so impossible right now. But it also makes alternative stores of value and yield-generating assets more attractive to institutional allocators. Here's the correlation most people miss. When oil spikes, risk assets like XRP initially sell off as investors flee to safety. But once the initial shock passes and people realize traditional safe havens offer negative real returns due to inflation, They stop looking for alternatives that can preserve purchasing power. The current XRP price action perfectly illustrates this dynamic. We're trading around 134, having tested resistance at 142 before pulling back towards support at 127. This isn't random price movement, it's institutional money positioning for the next phase of this cycle. Technical analysis shows us something crucial here. The trading bands are expanding, which historically precedes major breakout moves in either direction. The 127 support level represents a critical test, and I believe we'll see that level challenged before we attempt new highs above 142. But here's why that potential dip to 127 isn't something to fear. It's an opportunity to position for what comes next. Smart money doesn't chase tops. It accumulates on weakness when the fundamental story is strengthening. And make no mistake, the fundamental story for XRP specifically is getting stronger by the day. This isn't just about crypto adoption generally. It's about XRP's unique position in the cross-border payments infrastructure that's becoming essential as global trade routes face disruption. When traditional correspondent banking relationships break down due to geopolitical tensions, when SWIFT transactions face sanctions and delays, when businesses need to move value across borders instantly and cost-effectively, they turn to solutions like RippleNet. That utility demand creates price support that technical analysis alone can't capture. The banking license applications aren't just about stablecoin yield, they're about creating the infrastructure for a new global payment system where XRP can serve as the bridge asset it was designed to be. When Ripple operates with a banking license, when major exchanges offer seamless fiat to XRP conversions with institutional-grade custody, the barriers to adoption disappear. Congressional pressure for market structure legislation is reaching a fever pitch because lawmakers understand what's at stake. America either leads this transition or watches from the sidelines as other jurisdictions capture the value creation. The bipartisan support we're seeing isn't political theater, it's economic survival instinct. Treasury officials pushing for lower interest rates despite inflation concerns reveals just how desperate the situation has become. They know the current path leads to stagflation at best, economic collapse at worst. Alternative systems that can provide yield, preserve purchasing power, and facilitate commerce without relying on traditional monetary policy tools suddenly look like necessities rather than luxuries. This is why I'm preparing to add to long-term XRP positions on any test of that 127 support level. Not because I'm gambling on short-term price movements, but because I'm positioning for a structural shift in how the global financial system operates. The compounding effect of earning yield on crypto holdings during this accumulation phase cannot be overstated. While you're waiting for the next bull market leg, your holdings can be growing through legitimate, regulated yield opportunities that didn't exist even 6 months ago. Platforms offering 8 to 12% annual returns on stablecoins and crypto holdings are becoming mainstream financial products, not exotic DeFi experiments. When traditional banks can't compete on yield due to regulatory constraints and monetary policy limitations, alternatives that can offer real returns after inflation become magnetic for capital. The timeline for these changes is accelerating because the economic pressures are accelerating. We're not talking about a multi-year transition anymore. Market structure legislation is expected by April. Banking licenses are being processed now. Stablecoin yield products are launching across major platforms. Iran's continued threats to regional stability only intensify the pressure for financial system alternatives that can operate independently of geographically concentrated infrastructure. When physical shipping lanes face disruption, digital value transfer becomes even more critical. The next few months will likely determine whether this transition happens smoothly or chaotically. Smooth transition means gradual adoption, regulatory clarity, and orderly market development. Chaotic transition means crisis-driven adoption, emergency policy measures, and violent price swings as old systems fail faster than new ones can scale. Either scenario favors early adopters who understand what's coming and position accordingly. The difference is whether you're prepared for the volatility that comes with rapid change. XRP holders are uniquely positioned because they're not just betting on crypto adoption generally, they're positioned for the specific infrastructure layer that enables this new financial system to function globally. Bridge assets, cross-border settlements, institutional custody, regulatory compliance. XRP was built for exactly the use cases that are becoming essential. As we watch oil prices climb, economic growth stagnate, and traditional policy tools fail, remember that crisis creates opportunity for those positioned correctly. The banking revolution isn't coming, it's here. The question isn't whether traditional finance will be disrupted, it's whether you'll be ready when it happens. The signals are all around us. Regulatory clarity, institutional adoption, infrastructure development, and economic necessity, all pointing in the same direction. For XRP holders, that direction leads to a financial system where digital assets aren't alternatives to traditional banking. They are banking. Stay positioned, stay patient, and stay focused on the bigger picture. The headlines will catch up eventually, but by then the early positioning opportunity will be gone.